Good evening to all of you. At the outset, I'm sure you all are trying to figure out as to what's happened in the market yesterday, what's happened in the market today. The market has been pretty volatile. Yesterday, moving up, moving down, and today it's up like 600 points. It's partly to do with the budget, partly to do with some amount of short coverings, partly to do with some investors who are sitting on the sidelines waiting for the budget to unfold before they really put money into India. What I intend to do in this session is to analyze the Indian budget in its totality. If you look at this Indian budget, there are various aspects that the finance minister has tried to address. He has tried to have a very fine balance between growth, between inflation, between fiscal consolidation, and also has taken some steps as regards the governance issues are concerned. Just to give you a brief summary to start with, whenever we look at a budget, the first thing all of us do is to find if the budget is a realistic budget. Are the numbers which are put out in the budget achievable or not? Because that will dictate market sentiments, that will dictate the mood of the market. And the first parameter that we look at is what are the underlying GDP growth assumptions that the finance minister has taken when he has actually forecasted numbers for the next year. Because if the revenue number is right, then the expenditure normally is in line with the revenue numbers. If you look at the finance minister's underlying assumption for revenue growth, he has assumed that next year's GDP in real terms, that means without considering the impact of inflation, would be 9%, plus or minus 0.25%. And implicit in his assumption is a 14% nominal growth rate, which means that he's expecting inflation to be in the region of anywhere between 4.3 to 4.8%. Now, we completely agree with the fact of the nominal growth being 14%. In fact, our numbers are 15%. So there is clearly an upside to the revenue growth numbers. But what we disagree with is the components. Our view is that next year, we could see GDP growth rate being closer to around 8% in real terms, with an inflation number being closer to around 7%. So that's the change as far as composition is concerned. But when you take the two combined, we are quite confident that nominal GDP growth rate would be in excess of 15% next year. So that's fine. The top line number is fine. Coming to the fiscal consolidation, they are following the roadmap which has been laid down by the 13th Finance Commission. The 13th Finance Commission actually has laid down as to what should be the fiscal deficit of the central government for each of the next few years. And I will come to a slide on that. And they're exactly following the roadmap and trying to better it along the way. So if you look at the fiscal deficit for the next year, it's estimated to be 4.6% of GDP. And for this year ending March 11, they have achieved 5.1% of GDP. Now I'll be repeating this term fiscal deficit time and again. If you just want to understand simplistically what is fiscal deficit gives you the extent that the government needs to borrow to meet its expenditure. Because the revenues are not enough to meet its expenditure, so it needs to borrow. So higher the fiscal deficit means the government will borrow more. And higher the fiscal deficit is generally viewed negatively by the market, particularly if the spending is not done for productive purposes. So the fiscal deficit is coming down from 5.1% this year to a projected number of 4.6% next year. And these numbers I will evaluate in detail because you need to understand how these numbers come out to be 4.6%, because that will give us better confidence whether these numbers are achievable or not. If you look at the composition of the budget year after year, the finance minister always attempts to improve the quality of the budget, in the sense they would like to bring down the revenue deficit, which means the total revenues minus the expenditure I get for those revenues, they would always like to keep it low. And they would like to grow the planned expenditure. The planned expenditure is expenditure which is used for productive purposes. So every budget assumes that revenue expenditure would be growing at a lower pace compared to capital expenditure, and planned expenditure will grow at a higher pace compared to non-planned expenditure. And this budget is no exception. Last year they did the same projections, and I'll show you where they've actually achieved on that basis. And this year also they're projecting, similar kind of, roadmap. The budget has addressed a very important issue this year. They have tried to maintain growth without impacting inflation. The finance minister could have increased rates on excise duties, he could have increased rates on customs duties, but we are living in an inflationary environment, and if he had to do that, then we would have had a problem in further increasing the inflation numbers. So there has been no meaningful change in the tax, either direct taxes or indirect taxes. What he has done, however, he has broadened the range of services which are being brought under service tax and which are being brought under excise duty. So rather than increasing the rate for each item, he has increased the number of items which will come under the tax net. This budget continues to put money in the hands of the consumer. In India, if you take India's total GDP, 65% of India's GDP it comes from consumption. Out of that, 55%, that is 10% comes from public consumption and 55% comes from private consumption. So if you are the finance minister and you want growth to be protected, you want to make sure that the 65% component grows at a fast pace. So if you look at the last three budgets, and particularly post-Lehman, the finance minister has actually been putting money into the hands of the consumers. He's reducing tax rates, he's increasing the tax slabs, he's started off with a Nariga program, which is employment guarantee for rural India. He has given loan waiver to the farmers. He has had a 6-pay commission where he's increased salaries for government employees. So all this is putting money in the hands of consumers, because if you have money in your hands, you will spend, and therefore that 65% component will grow, and India will basically grow at a higher pace going forward. Because if you increase your GDP, then the fiscal deficit to GDP actually falls because the denominator increases. This year, they once again have come out with a reform calendar. They're looking at introducing the new direct tax code beginning April 1st, 2012. And they also made significantly progress now on the goods and services tax, likely to be implemented somewhere in the middle of next year, if you are lucky. They have been trying to do this for a long period of time. It requires a lot of consensus from the states. But I believe at this point in time, the probability of GST coming in within the next 2 years now looks pretty high. They've also introduced a slew of new bills which will going to be tabled in Parliament. A lot of them will see the light of implementation only, in the next financial year. Not this next financial year, but the financial year after that, which is FY13. The budget is not the document where the finance minister can fully address governance issues, but it has made an attempt to address issues on corruption, and it has made an attempt to bring unaccounted money or black money into the mainstream economy. And I will come to some proposals on that. This, in my opinion, is a very, very big development. As far as markets are concerned, it has now opened up mutual funds for foreign investors to invest directly into mutual funds. Today, any mutual fund scheme is available for investment by foreign institutional investors or sub-accounts. So there's not an issue. There are limits that each sub-account or each foreign institutional investor cannot invest more than 25% in the mutual fund. Now, this proposal seeks to bring in the foreign retail investors into our domestic mutual funds. This, in my opinion, is still 12 months away before you see the light of this proposal being implemented. The reason being the KYC norms. Know your client. In India, the KYC norms are not as stringent as will be required globally, because one of the key for KYC is to identify the source of money that comes from overseas. We want to make sure that it's not, money laundering, or it's not terrorist money, or any kind of money of that sort coming into the country. So KYC is going to be extremely important, and I can tell you that over the next few months, all the mutual funds are going to get together and try and figure out a framework of how can this KYC be done. If somebody from Chile wants to invest, how do I know about that client? Is he getting in, clean money in the country, or is he getting in money which is, tainted? So this is going to be a big issue. Till they figure out the KYC framework and create a system by virtue of which every mutual fund can follow KYC norms, this proposal may only be a proposal on paper. So it's going to be almost a 12-month, in my opinion, exercise before they get this money into the country. You could also see this happening in the broking industry. In fact, the thinking could be that today, if an foreign investor wants to invest directly into the Indian stocks today, rather than come to mutual fund, there's somebody who has to do the KYC. Internationally, in the US, the broker does the KYC for any international investor wanting to invest in the US. The issue we have today in India is that we've got multiple brokers and they're not well capitalized. And therefore, there's always a fear that the exercise of KYC may not be done properly. And therefore, if the mutual fund KYC framework is in place, who knows, you may also see this opening up to the broking industry where foreign retail investors will then be able to buy directly into stocks if they seek to do so. Now, what are the big challenges? The first big challenge is on fiscal consolidation itself. Yes, the finance minister has brought down the fiscal deficit number in his projections for next year, but he has dipped into the cash surplus to contain that deficit. The government is sitting on certain cash surpluses this year. He has released 20,000 crores into the budget of next year to reduce the extent of borrowing, which means that had he not put this 20,000 crores from his cash kitty, the borrowing program would have gone up by 20,000 crores. So that's the first point to note. This was not done earlier. So the cash surpluses are now being released into the system to bring down the extent of borrowing for next year. Number two, subsidiaries, and I wanted to mention this in detail because there's a lot of talk about number of, on the subsidy related issue. Subsidies in the budget are accounted for on a cash basis. What does it mean? If I were to put it in a simple example, let's assume today your child is going to school and you have to pay school fees. Now, instead of paying school fees for this year, in this current year, you pay the fees in the next year, but they actually are meant for this year. So you'll account for it only next year, but actually that fees is the expense for this year. That's exactly what he's doing in the budget. In the budget, the subsidies which are meant for this year, he has pushed part of it into the next year. And I will come to the detailed numbers on this. Okay, so what is happening today, we don't have an accrual concept, no matching concept, which means subsidies for this year should be accounted for revenue with the profit and loss of the government's accounts in this year. But what is happening is that there's a mismatch. The subsidy that you see here are actually some spillover of subsidies which he had to provide for last year. And there is still some spillover which he still has to provide for this year, which is going into next year's budget. So for example, last year for oil subsidies, the finance minister projected about 3,000 crores as subsidies. If you look at the budget numbers for this year, it is in the region of close to 38,000 crores. Now, out of this 38,000 crores, only 3,000 was provided in the budget last year. It expanded to 38,000 crores. Why? Because oil prices are high and subsidy burden increases as oil prices go up. So, what he has done effectively, out of this 38,000 crores, 14,000 crores of this year's subsidy in oil pertain to last year. And 21,000 of the balance, which is of 24,000 or so, was a subsidy which pertained to this year. But this year's actual subsidy is about 40,000 crores. So the balance of 40,000 minus 21,000, which is 19,000 crores, is actually supposed to be provided this year, but is going into next year's budget. So therefore, if you look at next year's budget, his subsidy projection is 3,000, which he normally provides, plus another 20,000 crores, which is a spillover from this year. Which means he hasn't provided for the entire subsidy on oil, which will occur in the next financial year. He will provide for that in the FY13 numbers, because he's doing it on a cash basis, not on an accrual basis. But this is the way he presents accounts year after year. So we have to accept that this is a cash accounting and not an accrual accounting. So all the numbers, when they say there's going to be slippages on fiscal deficit, they're assuming that it has to be on an accrual basis. If you do it on an accrual basis, there will be a slippage to the extent of 0.5% on fiscal deficit, which means fiscal deficit will go up from 4.6% next year to 5.1% next year. So that is the reason why you heard these mixed views in the market that the fiscal deficit number is not achievable. because all of us say that you have to account for it in the same year in which you are supposed to account for it, based on which it should be 5.1%. One of the biggest challenges, if you ask me, and the biggest risk to the market is our balance of payment. The balance of payment consists of two accounts, the current account and the capital account. The current account deals with your imports and exports and also your remittances, and the capital account deals with the capital flows that come in and out of the country. Now, India is having a negative balance on current account. We're running a negative current account. So if you want to balance your balance of payment, you have to have a very strong inflow of capital. The problem we have right now is that we are seeing outflows. So not only is the current account negative, our capital account is showing also weakness. If this continues for more time, the balance of payment itself starts turning negative. And if the balance of payment starts turning negative, the rupee starts depreciating. If the rupee starts depreciating, foreign institutional investors take out money from the country because the dollar returns come down. So this is the biggest risk to the Indian market. Now, do we have control on the current account? We don't, because the current account involves import of oil. We have no control on oil prices. So if the oil prices keep on going up, our current account becomes more and more negative. And we'll require more amount of inflows into the country to balance this current account. So it is very important for us to note this point, that moment the current account becomes more and more negative, foreign institutional investors also get more and more negative on India. And they take out money. So we have a double whammy. The current account becomes negative, the capital account also starts showing weakness. And that is, in my opinion, the big risk that I can see to the Indian market. So therefore, oil is going to be very, very critical. And therefore, all the tensions that you're seeing in the Middle East are very, very critical to the outlook on markets as we go in the next few months. So I can discuss whatever I want on the budget. At the end of the day, what will determine the sustainability will be the direction to oil prices.